Hi, I'm Dennis Lee, Associate Portfolio Manager at Morningstar Investment Management. Welcome to the Morningstar Market Minutes, where every Friday we take a quick look at what's been happening in markets, some key trends, and how we position our portfolio for the current environment. This week, the headline in the financial markets was President Trump announcing a new set of tariffs after the deadline of the 90-day pause since the Liberation Day. The new tariff, from what we know so far, are targeting goods from Japan, Korea, and some emerging market countries. But the reaction from global equity market has been fairly muted this time. This could be because the effective date of these tariffs are on the 1st of August, so even Japan and Korea seem to be taking a firm stance. Markets are hoping that some deal could still be negotiated in the next few weeks. For the upcoming season, it will be interesting to see how companies navigate the trade conflicts and the impact on their financial statements. While it seems like the share market has not priced in any downside scenarios on trade talks, the bond market is telling a different story. We saw the US 10-year Treasury yield move back up to 4.4% this week, showing some concerns about the return of inflation. And the latest FOMC meeting showed that the Fed still prefer a wait-and-see approach, and there are mixed opinions on the future path of rate cuts. Back in Australia, the RBA decided to keep the cash rate on hold at 3.85. Since the cut was largely expected, the decision to hold came as a surprise and caused bond yield to rise. The next important data will be Q2 CPI to be released in 2 weeks' time. While the situation is quite fluid around the world, the news pointing in different directions. For investors, we believe the key is to stay focused on long-term fundamentals and valuations and not being caught up in short-term speculation. We can assign probabilities to inflation, rate cuts, or even trade policies, but it's very difficult, almost impossible, to predict exactly when they'll happen or trying to time the market. Our current view at Morningstar is that we do see some concentration risk due to expensive large cap valuations in some assets, for example in the US. In our portfolio, we like the undervalued European sectors, including names like Burberry, Kering, and LVMH. Consumers have been cutting back on discretionary shopping due to the cost of living pressure. At the same time, the luxury brands are feeling the impact of a sluggish Chinese economy. And tariffs have also added another layer of uncertainty on top. But we think most of the risks are priced in, the fundamentals remain intact, and then the implied expectations seem a little bit too harsh on them. As a value investor, we see a compelling opportunity to own quality companies at a discount. And there could be upside once the consumer sentiment improves in the US or in China. That's it from me this week. Thanks for watching the Morningstar Market Minutes. Have a great weekend and we'll see you next week.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.